SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi e-lecture on CBDC and Bank Intermediation. My name is Ernest Gnan. I'm SUERF Secretary General and Counsel to the Board at the EMEA in Austria. In a recent study, Katrin Assenmacher, head of the Monetary Policy Strategies Division of the ECB, and an impressive team of co-authors investigate what the scenarios for the take-up of an e-euro might be, what the implications might be for banks' balance sheets and business models, for bank lending, and thus for the monetary policy transmission mechanism, and what the possible repercussions might be in the event of financial crises and bank runs. We are happy to have with us today Katrin with three of her co-authors, Dimou, Manuel, Munoz, and Oscar Sons, to present their paper in the first 30 minutes. Then, three top private sector experts will discuss the ECB paper. We are happy to have with us today Pablo Urbiola, Head of Digital Regulation at BBVA, Marc Niederkorn, Director of EMEA Payments Practice McKinsey Company, and Katrin, Director, Head of CBDC and Protocol at BBVA. Without further ado, I hand over to Katrin and colleagues. Katrin, over to you.
Thank you, Ernest, and thank you very much for inviting us to present this paper here. And as you already said, it's an impressive list of co-authors, and the reason for this is that we started out as a kind of brainstorming seminar to investigate different issues related to CBDC that may be of relevance for a central bank. So it was kind of an open brainstorming meeting where we met and discussed, and at some point we thought, well, we should put it down and publish it because we think that there is maybe value in what we looked at and what we thought about this topic. So that's why there are so many co-authors, and four of us will present, and Ramon, who is also co-author, is on the panel, so he can also answer questions. So please, next slide. And of course, as always, these are our private views and not views of the Eurosystem, so the usual disclaimer applies. So before I'm going into the details, I would like to give you a brief overview of what we looked at. So the type of analysis we were conducting. So we first looked at some scenarios to gauge potential demand for a digital euro. The main problem with a digital euro is that we don't have data related that we can base our analysis on. So we took the balance sheets, the demand for deposits, the amount of cash, excess reserves, and so on, and looked at that. And we, taking different assumptions, we came at a potential take-up of a digital euro between 500 billion euro and 7.5 trillion euro. So, and the breadth of this range already shows you that there is a huge uncertainty related to a potential take-up. With these figures, we then went to look at structural bank intermediation. So we looked at balance sheets of the central bank, of the banking sector, and of households to see how these balance sheets could adjust to a potential issuance of a digital euro. And then we looked at bank responses under liquidity regulation, collateral requirements, and the Eurosystem's credit operation, which all constitute frictions compared to the neutrality result of issuing digital euro that's around in literature, and tried to figure out where constraints and where frictions are present that could affect bank intermediation in the presence of a digital euro. And next, we then also looked at individual bank level data, because this is something that's always sensitive in the euro area when you have different countries and different banks sitting in different countries. And finally, from a financial stability perspective, of course, the stability of the financial system is very important, and it's often said that because holding digital euro is less costly than holding cash, that economy-wide bank runs could be facilitated by the existence of a CBDC, and this was the third topic that we looked at. Regarding the results, so first we found, no, please go back. we found that due to the presence of market imperfections and policy constraint, there are potential avenues through which a digital euro can affect bank intermediation. In particular, if certain restrictions could become binding. So that's liquidity regulation, collateral. And this could limit the extent to which banks can adjust to the issuance of a digital euro through certain channels. And the impact may be different across banks in different countries and with different business models. And for the scale and speed of economy-wide bank runs, we found that under certain conditions, the introduction of digital euro could exacerbate the severity of runs, and that safeguards, so-called safeguards, meaning that the remuneration of a digital euro or holding limits to a digital euro could be calibrated in such a way that these effects would be neutralized. So now I will be going into the analysis in more detail, so please switch. So first, looking at CBDC demand and these illustrative scenarios. So we took the current aggregate balance sheets to inform different analyses, and the main issues that determine the take-up currently are the level of the interest rate and the level of excess liquidity, and the amount of deposits that households are holding, cash and deposits. And of course, these are influenced by the level of the interest rates. So we made assumptions on what part of deposits and cash are used for retail payments relative to being a store of value. We made assumptions on how demand is shaped by different use cases and in different sectors. So what amount of deposits households, firms, non-banks, or the external sector would be willing to convert into digital euros, and also on the degree of substitutability between different forms of money. And finally, we also calculated scenarios where holding limits would be binding. And you see that these are very ad hoc assumptions, and the nature of these assumptions imply that all these calculations are subject to a huge uncertainty. So please, next slide. So we have three different take-up scenarios. So the first take-up scenario assumes that the digital euro will only partially replace other retail means of payments, and that demand would not be constrained by safeguards, by so-called limits. And this gives rise to a very moderate take-up, because a large part of the deposits and cash that's held at the moment is not used for retail payment services, or purposes. So this would give rise to a take-up in the order of about 500 billion. By contrast, if you assume that the digital euro would also be held as a store of value, and probably is even cheaper than holding cash or equally cheap to deposits, then the demand would be much higher. And in case take-up wouldn't be limited by constraints, we would have a take-up in the order of 7.5 trillion. So as a third scenario, then we looked at a scenario where there is a cap on the demand for digital euro. And the assumption is that all residents exhaust an assumed limit of 3,000 euro, which has been set forth in a working paper by Ulrich Binzal. And this would give rise to a demand for digital euro in the order of 1.2 trillion. So you can see that's a wide range, and all of these assumptions are to some extent plausible. So it's very hard to come to a definitive figure, but we use these three scenarios to look at different cases and how banks can adjust. Next slide. So this leads us to considerations on the potential on bank intermediation and to stylized balance sheet adjustment. So there are four different options that banks can use to adjust to the issuance of a digital euro. So first, the banks could adjust to the demand of the public for a digital euro by this demand could substitute banknotes, for example. So this would have no implications for the length of the Eurosystem's balance sheet, but it would just mean a swap between banknotes and digital euro. Second, banks could draw down on existing reserves. So similar to when the public is now demanding cash, banks would hand out cash that they have exchanged against their reserves. So this would run down existing reserves. We at the moment have huge excess liquidity. So this also wouldn't lengthen the Eurosystem's balance sheet, but would lead to a rearrangement of liabilities. And then there are two options where the demand for digital euro could lead to an expansion of the Eurosystem's balance sheet. So first, that banks borrow from the Eurosystem, so meaning that they need to get additional liquidity, additional reserves to satisfy the demand for digital euro, and they would hand in collateral and borrow from the Eurosystem. And fourth, that banks could sell assets in outright operations to the Eurosystem, which would mean that they either could do that from their own portfolios, so they have assets on their own balance sheet and sell this to the Eurosystem, or, which is more common, that they sell assets that the private sector is owning, be it corporates or households, and banks sell on behalf of the other sectors these assets to the Eurosystem. And depending on these adjustment options, we can look at how much demand for a digital euro could be satisfied through each of these adjustment options. And this is what the chart on the right-hand side is showing. You have the different take-up scenarios. So the solid gray line is the small take-up, 500 billion. The dashed line, take-up B, is without constraints, the 7.5 trillion. And then we have take-up C that's capped with different caps per person. And you can see that for the small take-up, the take-up for just retail payments, this can be easily satisfied through either option. So we don't look at option one, but on these options that are on the bank, on the Eurosystem's reserves. We have the option, the high take-up cannot be satisfied by banks drawing down their reserves or banks selling from their own portfolio, but the other two options, even so individually, could even satisfy these very high take-up. So there is enough unencumbered collateral, and there's also enough securities on the private sector balance sheets to accommodate such a demand for digital euro. So this is not to be considered as a constraint. What we want to show is that any adjustment option must involve the Eurosystem's balance sheet, because the issuance of a digital euro would be on the initiative of the Eurosystem. So the Eurosystem should be prepared to accommodate the increased demand for digital euro if it's not just changed by banknotes, but it needs to accommodate this demand and also be willing to provide the funding to the banking sector if the demand has a certain amount of digital euro. So, and I'll stop here, and then I will hand over to Maria, who will look at the bank. Sorry, there is still a slide. So that's what I said. So in theory, this shouldn't be affecting the monetary policy stance or a bank's intermediation capacity. But in practice, we have a number of frictions, which I have just looked at: collateral requirements, liquidity regulation, and so on. So with these frictions, once they are binding, the issuance of CBDC could affect banks' intermediation capacity and thereby affect monetary policy transmission. So there are limits to the equivalence result. So, and now I would stop and hand over to Maria.
Thank you, Katrin. I hope you can all hear me well. And thanks also from my side for having us with you today. So yes, so turning to the first slide. So one approach that someone can use when estimating the potential impact that the digital euro could have on bank lending conditions is to look at how banks actually reacted around information related to the digital euro as this was progressively being conveyed to the public. And to the extent that stock prices also convey future profitability prospect information, looking at the changes in bank stock prices around announcements related to the digital euro overall or to different aspects of it, such as design and timing, should provide a natural and unique opportunity to assess the impact of the project on bank business models, at least as perceived by markets. And this I would like you to keep in mind because we will come back to it later. So this is in fact exactly what we have done in one of the exercises that we will present to you today. And what we have done is to extract daily abnormal stock market returns for individual euro area banks using a standard FAMA French model around key announcements related to the digital euro. And in this chart that we are showing now, you can see the evolution of these returns since February 2020, which was the point when the first speeches related to the digital euro started to be communicated. And basically what we can see is that stock market prices on the aggregate barely declined after the announcement and remained at similar levels until at least early February 2021. And then we will see what happens. But before going ahead, what is more interesting to look at is the underlying heterogeneity in the cross section. And if we look at our first group of banks, which is the yellow dashed line at the bottom of the chart, we can see that they experienced a more pronounced decline, and it would look like as if they are perceived by the markets as being more exposed to a threat of deposit disintermediation. And here actually I come back to what I mentioned already before, and I would like you to note that we are not talking about an actual threat of deposit disintermediation, but rather one that is perceived as such by market participants. Now, going back to our chart and turning to the second group of banks, you can see that the yellow dotted line, which represents the banks less reliant on deposit funding, so it shows that these banks actually experienced an increase in their stock prices following the announcement. Now, this divergence across our two groups of banks rather seems to imply that markets perceive some bank business models as being posed to benefit from an introduction of a digital euro, while others are instead being perceived as being rather negatively affected. Now, looking at the events further ahead, and in particular what happened after February 2021, when we had the communication rather, of further details on design and timing, we can see that overall, the stock market reacted positively to that. And going back to our two banking groups, we can see that banks more reliant on deposit funding experienced a full rebound, whereas banks less reliant on deposit funding saw their stock prices remaining at levels higher than the ones observed before any of these announcements, which might suggest that markets perceive these banks as having the potential to take advantage of business opportunities that this new instrument might bring along, while at the same time they connect these banks less to the associated risks. And now let's turn to banks themselves. So how did they react to all this incoming information? And to answer these, we have looked at credit supply in the months immediately after the publication of the report on digital euro in October 2020. And to do that, we have mapped the abnormal stock market returns that I have just presented to you before to loan information sourced from Unicredit. And we have also controlled for potential confounding factors including loan demand. And the takeaways, let's say, from this chart are twofold. So first, as you can see, there was no differential pre-trend before October 2020. And second, any impact was temporary, and also its reversal seems to have reflected the communication, the detailed communication on design and timing. And this, in fact, seems to be consistent with what we have just observed with abnormal stock market returns. And with this, I will leave the floor to my co-author, Oscar. Thank you.
Thank you, Maria. So the next exercise in the paper again considers the structural impact of CBDC on bank intermediation, but then from a different angle. So in this section, we will simulate the bank balance sheet response to deposit outflows, taking into account the adjustment options that Katrin presented, specifically 2 and 3. So banks can use their own reserves or can obtain additional liquidity from the central bank, as well as bank level constraints, such as the heterogeneous distribution of reserves, but also liquidity requirements and liquidity buffers currently on the bank's balance sheet. So the approach here is then to have a bank level cost minimization model, where each bank is subject to deposit outflows and then will individually adjust its balance sheet with the goal to maximize its profits, but subject to a set of constraints. So when bank deposits are withdrawn from the bank's balance sheet, the banks in the simulation model must decide on either using its own excess reserves to obtain CBDC, or to resort to alternative funding sources, which can be either on the interbank market, so that the banks can obtain additional liquidity from the interbank market, or they can go to the central bank to obtain additional central bank funding. And these options then can be either short-term or long-term, or secured or unsecured. The choice then of banks in this model is driven by a set of constraints, and that's really where the complications are going to kick in. So what we include is liquidity regulation, so both the LCR and the NSFR requirements. We also incorporate the collateral requirements on secured funding and the availability of unencumbered assets on each bank's balance sheet, and also the availability and the distribution of excess reserves. Where I want to highlight that we do not only allow banks to use their own excess reserves, but also to obtain these on the interbank markets, which requires a bank that has sufficient excess reserves to provide them on the interbank market. Finally, the choice of funding option is then driven by the relative prices of these options, where we assume a more, let's say, normalized environment where the rate on excess reserve is a floor to prices and the rate on central bank lending provides a ceiling. So then on the next slide, I will present the key messages from this analysis. But first, I want to highlight that by assumption, it's the most cost-efficient option of banks to use the excess reserves to obtain CBDC. And with this assumption, we find that for low CBDC demand, indeed, as Ollers has also found, most banks can accommodate this with just their own reserves, because we are in an environment with high excess liquidity, which the data that we use for this analysis is Q3 2021, so very recent data. And this is also shown on the figure on the right. So on the x-axis, it shows the percent of deposit outflows, and on the y-axis, it shows the deposit outflows in billion of euros. So on the left of this figure, the 2 bars are mostly dark blue, which means that these banks can just use their own reserves to satisfy the demand for digital euro. On the second bar, if you look very closely, you see a slight light blue bar at the top. And this means that there are some banks that do not have sufficient excess reserves themselves, and they will obtain additional liquidity on the interbank market. Now, if we increase the CBDC demand in this simulation model, so we move towards the right in the figure, we see that more and more banks become first constrained by their own reserve holdings and then by the LCR and the NSFR liquidity regulatory requirements. So the more we move to the right, the more excess reserves are used, but then also the light blue bar starts increasing. So more banks rely on the interbank market to obtain funding. But this interbank market can only be used if there are still sufficient excess reserves in the whole system of banks in the sample. So once we reach approximately 18 to 20% of deposit outflows, there are no more banks on this interbank market that have excess reserves and are not constrained by their own LCR requirements. And at that point, banks require additional central bank funding. And that's displayed by the dark green and the dark gray bars that are then increasing once deposits outflows increase. So what we see then on the figure is that indeed scenarios A and C presented at the start can be accommodated easily by banks in a high liquidity environment, but scenario B, which is a high CBDC demand, at that point, banks would require additional central bank liquidity to accommodate this demand. Where in this simulation model, this has to be a long-term central bank funding provided against non-HQLA collateral. It has to be long-term because banks become NSFR constrained, and has to be against non-HQLA collateral because banks become LCR constrained. So finally, let me finish with two qualifications. First, I want to highlight that an important assumption is that we assume a perfect interbank market, which means that all banks have equal access at the same price. And in reality, this of course may not be the case, where some banks may be disproportionately affected if they do not have the same access. And second, we use this recent data with high liquidity, and that also facilitates the introduction of CBDC. So then let me pass on to Manu for the final part of the presentation.
Hi, everyone. Thanks a lot. So the last section of the paper studies the potential effects of the introduction of a digital euro on economy-wide bank runs. Moving to the next slide, it has been argued that a digital euro could exacerbate the severity of economy-wide bank runs to the extent that deposits can be converted into a digital euro at a quicker pace and in a less costly manner when compared to conversion of deposits into central bank money or cash. Against this background, we have constructed two models for bank run analysis. The first one is a model for simulated bank runs, and the second one is a model with CBDC cash and safety preferences based on the Diamond and DeVig literature. In the interest of time, and given that this second model is carefully described and presented in a forthcoming ECB working paper co-authored with Oscar, I'm going to focus on the attention on this first model, which is also based and which relies on the three illustrative scenarios Katrin has presented. So what you can see is that crucially, individuals can convert deposits into cash and/or CBDC, and CBDC is assumed to be technologically superior than cash to the extent that the latter are assumed to be subject to storage costs, as in reality. Now, importantly, bank runs can be triggered based on an individual expected return maximization behavior in this model, and this model is used to simulate bank runs and can roughly replicate the scale and speed of past bank run episodes, as you can see in the next slide. In particular, in the next slide, on the left-hand side panel, what we do is to basically calibrate the model so as to roughly replicate the scale and speed of deposit withdrawals in two past economy-wide bank run episodes, the one that took place in Greece in 2014 and the one that occurred in Cyprus in 2012, we take the former, and on the right-hand side panel of the slide, we basically plot, along with this no digital euro scenario under this calibration for the case of Greece, we also plot what would be the deposit withdrawals in the event of a bank run episode of similar characteristics under digital euro take-up A and under digital euro take-up B. There's two main findings. First, as you can see, scale and speed of bank runs are larger under these assumptions in the case of digital euro. And second, somewhat paradoxically, you see that under the moderate digital euro take-up, actually the scale and speed of the bank run is larger, and that is because since the deposits that were converted in normal times, once the digital euro was introduced and prior to the occurrence of the bank run, the amount of deposits available to be converted into central bank money during the bank run is larger. And now finally, we move to the next slide in order to show how one can neutralize this potentially these adverse effects of potential economic bank runs a digital euro could induce along the dimensions of the scale and speed of these events. We differentiate here between a hard and a soft limit on individual CBDC holdings. The hard limit basically imposes a threshold beyond which individuals cannot hold any positive amount of digital euro. The soft limit or two-tier remuneration scheme basically establishes a threshold, as you know, beyond which additional holdings can be held, but only but they are subject to a punitive or dissuasive interest rate on this tier 2 holdings. So regarding the panel A, the hard limit, you can see that by calibrating the threshold of this hard limit on individual holdings, one can affect the scale and speed of bank runs. When looking at panel B, and by fixing the soft limit on tier 1 holdings, one can see that by calibrating the interest rate on tier 2 individual holdings, one can also eventually neutralize the effects on the scale and speed of a bank run induced by the introduction of a digital euro. And finally, when we look at panel C in the next slide, we can see that if we set the interest rate on tier 2 holdings to a sufficiently low level, one can also calibrate the scale and speed of a bank run by changing the limit on tier 1 individual holdings. And finally, in panel D, what we do is to combine this two-tier remuneration scheme with a limit on flows, in this case, a convertibility limit, which limits the amount of deposits that can be converted into a digital euro, and then setting the tier 2 interest rate to a particular level. We can see that also by calibrating this convertibility limit, one can also manage this risk of an exacerbated bank run potentially induced by a digital euro. So in conclusion, moving to the last slide, in conclusion, as Katrin has mentioned, there's 4 main adjustment channels through which banks can adjust in the event of the introduction of a digital euro. Due to the presence of regulatory constraints, frictions, and bank level specificities, the introduction of a digital euro can affect bank intermediation capacity, and such effect may vary across credit institutions. And importantly, due to the presence of certain constraints, the extent to which some banks can adjust through certain channels may be limited. We have also shown that under certain conditions, a digital euro could potentially amplify the scale and speed of system-wide bank runs, but by adequately designing and calibrating CBDC safeguards, one can neutralize such adverse effects. And finally, it is worth noting that given the high uncertainty surrounding important issues such as some of the design features of a digital euro, the actual demand for a digital euro, or the prevailing environment under which such a CBDC would be issued, it will be important to update and extend this analysis in the future. Thank you very much.
Thank you very much for this excellent overview of your paper. I don't want to comment in detail, but I think you summarized it very well at the end. And one takeaway for me is that different banking systems in different countries and also different individual banks, depending on the business model, can be affected quite differently. And also, very impressively, depending on different options for CBDC design. So, I mean, this is the great benefit of your exercise, that it really informs policymakers of the possible consequences of various CBDC designs in order to make an optimal and also a stable and an equitable design that doesn't cause any major difficulties among some groups of banks or among some groups of countries. So I'm very happy to now invite as our first discussant Pablo Urbiola, Head of Digital Regulation at BBVA. Pablo, floor is yours. We don't hear you yet. Can you unmute? Unmute Pablo, please. I think now you could speak.
Yeah, can you hear me?
Yes, we can.
Okay, thank you. Thank you very much for the invitation to discuss such a relevant topic, and thank you also to the colleagues from the ECB for the presentation and their excellent paper on such a relevant topic. I will center my comments on some key takeaways from the paper, which I think should be carefully taken into account in the design of a possible retail CBDC in the Eurozone. I think one of the main takeaways from the paper is the enormous difficulty of estimating the demand for a retail CBDC and estimating the extent to which it will replace demand for cash and or bank deposits, which is key to analyze the impact on bank intermediation. From a conceptual perspective, the demand for a digital euro will be driven by two different, although related, factors. One, its use as a means of payments, and the other one, its use as a store of value. The use of a digital euro as a means of payments will depend on how it is designed and how it compares with other payment alternatives, such as cash, cards, or instant payments, in terms of the payment functionalities that it offers, how easy to use the digital euro is, or the costs that it entails for payers and for merchants. Another relevant factor will be the legal status of a digital euro and the obligations for merchants to accept it as a means of payment, which could give it an advantage over other electronic payment solutions. Despite all the uncertainties that are involved, I think that a very interesting area for further research is how different design options and designed scenarios can translate into different take-up scenarios. So I think further work and analysis on this front would be very helpful for the design of the digital euro. I think in general terms, the more payment use cases a digital euro covers and the better it compares with other payment solutions, the larger the demand for a digital euro as a means of payments will be. And as regards the substitution from cash or deposits, this will depend on whether the design of a digital euro is closer to cash, to electronic payment instruments, which are generally linked to bank deposits, or closer to both at the same time, to cash and electronic payment solutions, as the combination of different design approaches is also being considered. For instance, the possibility of combining an online and an offline functionalities, because technology allows, in theory, to bring together different features from cash and electronic payments to get payment solutions. I think in this regard, the ECB is paying special attention to two features that could make a digital euro closer to cash. One is, as I mentioned, the possibility to make offline payments, and the other one is the degree of privacy or anonymity. Privacy has been underlined as a key feature for users in the design of a digital euro. However, I think the actual impact that privacy may have on the demand for a digital euro is more uncertain, at least for two different reasons. The first one is that a digital euro is unlikely to be as anonymous as cash due to AML and CFT considerations, and thus a digital euro won't replace the demand for cash that is attributable or explained by illicit activities. And second, citizens tend to value privacy a lot in surveys and consultations, irrespective of whether it is about payments, about social networks, but in practice, revealed preferences are less clear. And if we discuss payments in particular, I don't think that there is a concern on the degree of privacy that is currently offered by the most commonly used electronic payment solutions. So I think it is not clear to what extent privacy can be a very relevant driver or factor behind demand for a digital euro. As I said at the beginning, the second key determinant of demand for a digital euro is the use as a store of value. Estimating this demand, I think it's particularly challenging, even more than the demand as a means of payments, given the very special nature of a retail CBDC with respect to existing forms of money. Currently, citizens only have access to central bank money in the form of cash and banknotes, which, as it was said before, are costly to store and subject to security risks. In contrast, a digital euro would have significantly lower storage costs and security risks, and it could be regarded as a superior form of central bank money, more
We don't
prone...
hear you. Yeah. Okay, hear you again. Can you repeat the last sentence?
Yes. So a digital euro would have significantly lower storage costs and security risks than cash, and therefore a digital euro could be regarded as a superior form of central bank money, more prone than cash to compete with bank deposits as a store of value. That competition will depend on two variables. One is easily observable, the remuneration rate of the digital euro and bank deposits, but the other variable is more challenging, or it's more abstract, and it's the relative perception of safety of central bank money versus commercial bank money. In normal circumstances, I think citizens are generally not conscious, not aware of the difference between money issued by the central bank and money issued by commercial banks, in part because the latter, commercial bank, is subject to very strong regulation and supervision, and also subject to the protection of deposit guarantee schemes. However, the narrative of central banks' projects on retail CBDCs, and particularly the emphasis on preserving access to the safest form of money in a future cashless economy or society, this narrative can increase citizens' awareness of the difference between different forms of money, and this can drive up the demand for central bank money, not only in crisis situations, so in a bank-run episode, but also to some extent in normal circumstances. I think all these uncertainties and challenges to estimate the potential uptake of a digital euro, these uncertainties mean that the possibility of a very high demand, driven not only by the use of a digital euro as a means of payments, but also by the use as a store of value, this possibility cannot be ruled out or disregarded. And as the paper points out, a large unconstrained demand, which is a possibility, would require a significant expansion of the Eurosystem's balance sheet. And in the case of an economy-wide background, and unconstrained demand would lead to an increase in the scale and speed of bank runs. Therefore, I think this underscores the importance of setting limits on individual holdings of digital euros to prevent undesirable consequences for the economy. Two different types of limits are being considered by the literature and also by policymakers. One is a hard cap on the individual holdings of a retail CBDC. Another possibility is a soft limit with a tiered remuneration that penalizes the holdings of a retail CBDC above a certain threshold or soft limit. I think the ECB paper provides some interesting results on the effectiveness of both types of limits in case of an economy-wide bank run. A very negative interest rate of at least minus 20% on the tier 2, on the second tier, would be needed for a soft limit of 3,000 euros to limit the scale and speed of bank runs to the same extent with the same effectivity than a hard limit of 3,000 euros. So a very negative rate on a central bank liability directly held by citizens would be needed. And this could be a challenge for the public perception of the central bank and lead to political pressure. And this leads me to some final reflections on the increased role that the central bank would need to play, or at least be prepared to play, in an economy with a retail CBDC. The paper acknowledges that in the presence of market imperfections and constraints, a digital euro may affect banks' intermediation capacity, and the central bank should be prepared to provide non-HQLA long-term funding to ensure banks do not have to go below their preferred liquidity ratios to meet CBDC demand. In such a scenario, the Eurosystem borrowing conditions and requirements on eligible collateral and purchasable securities, these conditions and requirements would become increasingly relevant for bank intermediation capacity and for the lending conditions in the economy. And this implies the central bank may face increased trade-offs, for instance, between the quality of the assets that it accepts and the liquidity position and risks of the banking sector, as well as the more basic trade-off between satisfying clients' or citizens' demand for a digital euro and preserving the limits on holdings to avoid undesirable effects on the lending conditions in the economy. I think the central bank, faced with such trade-offs, it may be subject to more political pressure, and this can have an impact on the independence of the central bank. And I think this is also a dimension of the discussion on retail CBDCs that should be taken into account in the debate. Thank you.
Thank you very much for these excellent and detailed comments. I would like to give the ECB team an immediate opportunity to react.
Yeah. Thank you very much for this discussion. I must say I agree with a lot of points you raised, in particular with the point on further research on take-up and design and demand. So it is indeed very, very difficult to link design features to potential demand because we don't have data. And so we did kind of a back of on the envelope calculation, but we see that we can certainly do more. And what we are at the moment, of course, concerned about is the rather exceptional monetary policy situation with high excess liquidity and very low rates, which probably will revert in the time to come. So we are focused more on this part because we come from the monetary policy wing and less on the technology implication. And I also agree with you what you say on privacy. So we want to protect privacy, but it's very clear that the central bank has to adhere to existing regulation, and privacy doesn't mean anonymity. So with cash, it wasn't possible. With CBDC, it's of course possible to have certain safeguards against money laundering or terrorist financing. So these regulations have to be respected. And I think, as you say, the privacy, the real preferences on privacy don't match with the preferences that are voiced in surveys, But I think what is very important is trust into the central bank. And if the public doesn't perceive the central bank as a trustful issuer of CBDC, then we are having a problem. And I guess in that context, also ease of use is key. And finally, your point on the political pressure, I wouldn't see it so negative. I think, this is intended as another means of payment, so it's suitable for payments in the digital age. And I wouldn't expect a huge change in how the financial sector works. So a lot of these trends that have been there in the past, shift to non-bank payment service providers, this has been there already. It could accelerate with CBDC, but I wouldn't see it as a case for a huge shift in political pressure and a threat to central bank independence. So on your other points, I would invite my co-authors to respond. So the points on bank runs, limits, and these things. Thanks.
Oscar, would you want to add something?
Yeah, Oscar, yeah.
Yes, just to one thing to respond to your comment about, let's say, the takeaway that you could have from a paper where the severity of bank runs seems to potentially be higher in case of an unconstrained CBDC and may require very negative interest rate in case of a tiered remuneration in order to bring it back to the level that we simulate without a CBDC. I think there, what I would say is the takeaway is not necessarily the number on this interest rate, but it's more what is in the background and what is determining how negative this interest rate must be, which is the idea that if you have a digital form of central bank money where you can instantly, super easy with the press of a button, convert bank deposits into central bank money rather than stand in line at ATMs or have to store the cash under your mattress and hold it for a very short period of time. So if there's some financial stress, you maybe only want to hold it for a week or for a month maximum. And that requires then on a yearly basis a very deeply negative interest rate, but it's because you only want to hold on to it for a very short period of time. And that I think is an interesting insight from that exercise. Manu, would you like to join?
Yeah, just to say, so I think one very important message delivered in this ECB paper is that basically the central bank can undo whatever it does, and that so let me emphasize again that the central bank is a benevolent actor, and that even under very, in some cases, unlikely assumptions and under very specific conditions that a digital euro could lead or could amplify the severity of bank runs, even under those conditions, about which it's likelihood we are not talking about, the central bank can neutralize that effect, but by adequately designing and calibrating the CBDC. I think this is a very important message, because as Oscar was highlighting, we rely on different models and we adopt different approaches because indeed each of them make different assumptions. Depending on the assumptions one makes, the origin of a bank run is going to be one or the other, and all of them are subject to some limitations. But in any case, that's the relevant bottom line, I would say. Thank you.
Thank you. I would propose that we now proceed to Marc Niederkorn, and then collect further questions as they come along. Marc?
Ernest, thank you for the invitation. And again, congratulations to the team. I think this is a path-breaking piece of work that tries under very, very difficult circumstances in terms of, understanding what a digital euro could look like, what the design features are going to be, et cetera, where we're still quite far away, to nevertheless draw a number of extremely important conclusions. Now, there's a couple of points that I'd like to more specifically comment on. The scenario that I understand we're painting is the one of a constrained CBDC. I'm not an economist by training. I would like to translate that into a vocabulary which I understand easier, which for me means the idea is to say, can we design what I would call moderately successful new payment system? And what I mean by moderately successful is, of course, it needs to be successful, right? If not, it defeats the purpose that we are pursuing, which is the monetary anchor that we want to create and all the other good objectives. On the other hand, we don't want it to be too successful. First, not to wipe out other forms of payment, but then also to kind of limit the overall impact that it has. And this is in terms of the amounts that we're talking about, the constraints that we're putting in are effectively working to that purpose. Now, the difficulty is, my experience is that in real life there is no such a thing as a moderately successful means of payment. Means of payments, in particular when we're talking about retail means of payments, are either a failure or they are seriously successful. Now, we could expect, for many reasons, a CBDC to be very problematic from a retail customer's point of view. What I mean by that is, today, when we're looking at the European situation, by and large, there is no perceivable market failure, I would argue, in terms of availability of means of payments. Customers can pay in all geographies, in all situations, either by cash or by widely accepted means of payments, which are credit cards, debit cards. There are very, very, very few situations where today you would say, oh, there's a real need in day-to-day life for retail customers to use a means of payment which doesn't exist today, which would be the CBDC. And look, that's what we're talking about today. The most aggressive agendas in terms of real availability for CBDC to the retail customer in Europe would be, what, 3, 4, 5 years out before they would be really available. So in all likelihood, we're going to be in a situation of a market which is quite well served, quite saturated, and where there is no urgent need for an additional form of payment, which would be CBDC. Also, what is important is that by and large, payments in Europe, and in particular retail payments, are extremely effective. On the McKinsey side, we're running what we call the payments map, where we're trying to estimate the total cost of payments to the economy. And we do this for Europe, for Asia, for the US. And all in, and I'm aggregating in an extreme way, the means of payments in Europe cost about 1% of European GDP. For the US, it's about 1.8. For China, it's about 4% of GDP, the cost of means of payment. So effectively, we're in a situation where we're saying, well, CBDC, we know why central bankers like the idea of introducing a CBDC, but it is a solution which is in search of a question today, because there is no real perceivable need on the retail side, nor in terms of use cases, nor in terms of effectiveness. On the wholesale side, it's a totally different game. On cross-border payments, it's a different game. There's all kinds of use cases for which CBDC cases, there's a real business case and a real demand. But for the time being, for the purpose of the paper, but also for the purpose of the work of the European Central Bank, most of these use cases are excluded. So I would argue, my thesis is, there is no moderately successful payment system, which is the one that we're imagining here. I believe that there is a significant chance for a CBDC-based system not to be successful at all, because there not to be any real demand. Now, if we just park that as a hypothesis because it's only my, intuitive assumption for the moment. And we say, no, look, we will find a combination of neat design, neat features that will make this form of payment appealing to all customers, or at least to certain type of customers. Well, in that case, it is very difficult to imagine that the kind of limitations that we're imagining today are either really enforceable or even really useful. Let us take a few examples. If we're saying we're going to moderate the whole system by keeping the holdings per individual capped, well, that requires that we can actually identify across Europe or maybe across the EU zone an individual, but there is no unique ID system available for the moment that would allow me to understand and identify in an absolutely 100% way an individual, and so therefore to enforce these limits. Even more today on existing mechanisms. So like, for example, deposit insurance, there is active mechanisms, offers like Weltsparen, Raisin Bank, etc., that allow me as a retail customer to actively circumvent these mechanisms by opening accounts in multiple banks, by leveraging these platforms, these marketplaces in a way to kind of circumvent these limitations that exist today. So I believe that enforcing these limitations is going to be extremely hard, if not impossible. Both the cap, because of the absence of a unique identifier for European citizens that effectively works and practically works. The interest rate debate, I think Pablo made already the remark that say, in a situation of falling knives, these rates would be so deeply negative for people to dissuade them. And the same if we're thinking about the limit of usage outside of the EU. In the paper and in the general publications, we're describing it as people that intend to travel within the EU or to spend it within the EU. Again, a notion that is very, very hard to enforce. And even the limit between retail and wholesale, because all the merchants that these customers are going to spend money at are going to be wholesale customers. So the spillover from retail into wholesale is going to be very likely. So point one, no moderately successful payment system. Either it works and then it's wildly successful or it doesn't. And these limitations that we're imagining today in practical terms are going to be very, very, very hard to enforce. Now, my last and final remark on this is we are reflecting on these measures and their impact on the banking system as we know it today. Again, the CBDC availability, at least in Europe, is going to be at least 3 to 5 years out, which in this day and age are very, very long time periods. Now, let me make a slight diversion into the world of cryptocurrencies, stable coins, and decentralized finance. This was all the rage until, 6 or 8 weeks ago. It is crashing in a quite impressive way over the last weeks. Nevertheless, what is really interesting is the fact that the technology that has developed on the back end of it, in particular, when it comes to decentralized finance applications, I believe gives us a glimpse in terms of what the world of finance and the world of banking is going to be in the next decade or 10, 15 years, at least sometime out. Now, let's imagine DeFi not powered by some flimsy Bitcoin or Dogecoin or what have you not, but powered by digital central bank currency, so where there is no doubt on the value or no doubt about the mechanisms that are around it. What does this mean? Well, what this means is that in this world, the retail customer does not need a bank to deposit money. CBDC, the liability is on the central bank, and the qualified intermediary can be, to be defined, all kinds of players that exist out there that would be regulated, but it, in and of themselves would not be banks. So to deposit money, you do not have to work with a bank. To pay money, you don't have to work with a bank. The qualified intermediary and the mechanisms to be imagined can take care of that. And DeFi shows us that to borrow money, to lend money, to invest money, you do not need banks. So effectively, what I'm arguing is that once we're opening this Pandora's box, and in all likelihood we will open it, the limitations, either it's going to be a total failure and it is not going to take off, or we're going to move really into a world where we have to imagine banking in a very, very different way, a much more disintermediated way than what we know today, where banks will have very different economic models because they're not needed to store money, to pay money, to borrow money, or to invest money, but there's other ways around this. Again, DeFi being the example. This is the world that we have to reflect against and measure ourselves against. So the limitation of the description of the effects on current banking balance sheets and banking mechanics is going to be insufficient. And therefore, the important part is this is going to be a really radical transformation for banks where the moderating mechanisms, as I believe, will not really protect them, at least not in the long term. And therefore, to make sure that the European banking system will remain competitive, I think we're firmly convinced that there's a need to move much faster on the introduction of CBDC as it is for the moment, but also in a more progressive way, a bit like what we're seeing in other geographies, rather than in a big bang type of logic, more in a pilot-driven logic where we're opening it up in certain areas to certain amounts, to certain use cases, for banks not only to create a sense of urgency, which I believe is still widely lacking today, at least in our conversations, but also to allow to really and firmly project themselves in a world which is going to be disintermediated, where the technology which we are seeing emerging out of the Bitcoin stablecoin DeFi type of world for the moment is going to be coming to a full bear, and therefore where the parameters of the problem are going to be radically changed compared to the logic that we have for the moment. For me, that would be the nature of my remarks, and I would stop here.
Thank you very much, Marc. I would suggest, in the interest of time, to give Katrin by all means the opportunity to also bring in her comments, that we now switch to Katrin Gu and then have responses on the last two discussants together. Katrin, are you in? Yes, hi.
Yes, I mean, hi, thank you. And thank you very much for inviting me. It's an excellent paper, and it was really enjoyable to actually read it, because I think I just want to say that the more sort of, even at the moment, without, enough of empirical data, but to do these sort of simulation works and to sort of anticipate the state of the world in the future, I think it's super important for us all to kind of read about it. Obviously, me not being a sort of a central banker, there's a lot of things is very new to me. So, when I was reading it, I think the main way that I was thinking in the back of my mind is more like on the point about the different substitutability effect and how consumers and users in general will react to it. Because I think, for all the different type of scenario that was being projected, is really trying to look at if something is going to happen under that moderate approach versus a large demand versus the capped. Now, however, these three are big assumptions to make. And as the paper recognizes well, all of these is based on assumptions without any real data to really sort of estimate it. So I think like the focus for me as I'm thinking about it is more on that user aspect, and to think about, what it means and what would it take for anyone to say have a moderate type of demand versus an extremely successful one that Marc was describing earlier. I think there's many ways to think about it, right? Firstly, I think, as everyone would appreciate, if a user of any new technology, the most convincing way for you to start adopting any technology which is new is that if that technology gives you an experience which is seamless, familiar, and trusted. And I think all these three subcomponents are super important. That trust aspect is an absolute must. It's not sufficient, but it's necessary condition, right, to make the CBDC successful in any country. And I think even digging into that trust element a little bit, I think there's more research we can do, and it could be something simply like user surveys and stuff, both on the qualitative as well as quantitative ways to start gathering data. And in fact, we actually ran this data on crypto side last year, and trying to embed some questions about, the trust for governments, trust for centralized entities versus trust for, say, if you're using just your fintech and an app that you don't really have a physical and entity to identify with. And it was really interesting because you definitely see there that there's very differentiated preferences for people of what they trust. I think typically, and for the majority of the population, they do trust their government, the centralized entities, a lot more because you have the laws and the protections. And I think this, gives that indication when it comes to CBDC, we absolutely need the right framework and the law and regulation to kind of make sure people understand the safety aspect of it. But having said that, users, I think, to a large extent, especially the sort of the younger generation, first, they want to have the sort of newer experiences that can interact with other sort of applications already available today. For example, if you do own a Coinbase wallet, or if you own a MetaMask wallet, and in the future you want to have a CBDC wallet, you want to figure out, how all these different type of wallet applications can interoperate, and that implies on the ease of usage of your specific CBDC relative to other things. So I think, when you have different segmentations of the user kind of market, that sort of start to make the design of CBDC a lot more complex, because CBDC is meant to be generalized, but depends on the preference of the consumers as well as the merchants and businesses. That will imply the different design features that you might want to have the flexibility in order to, I guess, to adjust, depends on the type of user you're looking to cater for. So definitely on that sort of trust aspect, which then sort of implies the ease of usage and how seamless it is with respect to other things, is important. And I think kind of just looking beyond the sort of what the other two guests have mentioned as well, I think just thinking about the broader picture of what the future of money would look like in general is quite interesting. And I think Marc probably touched on that quite a bit when he was talking about the DeFi aspect. And I would just highlight, the growth of stablecoin right now is enormous, right? I think if you're looking at simply just how much people transacted using stablecoin on the blockchain as of 2021, the data that we collected, and these are public data you can get, on Ethereum alone, that amounts to $6.5 trillion-ish. That's kind of the estimate you have. And I think especially, we just saw the announcement of Circle releasing the stablecoin version in Europe as well. It will be interesting to figure out, what is the demand and usage for the stablecoins, because I think by sort of in the future studies incorporating more of the sort of different substitution effect and preferences for stablecoins versus cash versus CBDC is going to be paramount, because again, as we're looking at who will be using these CBDCs, I sort of colloquially, I don't think my grandparents are likely to adopt to a completely digitized version, but I definitely think my peer and the younger generation will most likely, and this is where you get the substitution effect, which will infer on that elasticity of demand the most, because, as you're comparing the different, say, design features of a stablecoin versus CBDC, what the different remuneration, what the yield generating effect of stablecoin versus CBDC versus the sort of risk profiles of these different type of money will imply a lot in terms of, to what extent, say, in a crash scenario, everyone wants to convert their money into CBDC versus in a normal time, what are different type of people's preferences for stablecoin versus CBDC versus cash and versus bank deposits. I think that's super important. I guess other comments I have throughout the paper are, for example, the aspect around offline payments is an interesting area. I'd love to understand more about the impact of offline payments that will have on, say, bank deposits and other things. I think offline payments is such a new thing. It's very hard to estimate. I think, of course, the closest sort of family you can look at is the cash. But I think in terms of, as we're thinking about the offline money and a digitized version of offline money, there could be a lot more different use cases that we can enable beyond what the cash use case could be today. And I think, cash use case today is simply trying to be a sort of a backup option, just because, the way that you can use your card or use other sort of digital money is a lot more easier to do. So cash really comes in as that backup option. Now, if we're thinking about the future of offline money, does it necessarily have to be only an a backup option? That is TBD. And again, what is the impact of that? could imply to people's different user cases and users' journeys in which you want to adopt an offline scenario completely and for a significant amount of time. I think those are sort of unknown territories that we will have to sort of start gathering data, maybe just through, again, user surveys and stuff to begin with, and to understand the future impact of that. I guess the last thing I want to maybe just as a question to pose is, we have seen a lot of use case being proposed of how fiscal policy could leverage CBDC. And this is going to be a very huge aspect of how CBDC could be used, say, for government disbursements or other stimulus bills down in the future. I think that will impact on the overall aggregated demand for money, on the aggregated demand for CBDC, as well as the individual sort of competitions of, how banks would offer these disbursement, what is the type of services you can offer on top of, and how you design your business model, and so on and so forth. So I think this is an area that I don't know enough about, but the interplay of the implementation of CBDC for both monetary policy purpose, but also to be used in the future for fiscal aspects, and especially I think in a very complex jurisdiction like the European Union, where you have different type of fiscal policy in between different countries. I think that will be interesting to understand how the future of leveraging CBDC could impact both on the monetary side as well as the fiscal side. So.
Okay, thank you very much, Katrin. I think this is now enough food for thought in principle for Katrin and colleagues. I mean, we have another question in the chat by Heike Mai, and I'm not sure whether Heike wants to speak herself. Heike, can you hear me? Well, if that is not the case, then I read Heike's question. Heike says, regarding bank runs, would it be possible to simply suspend the exchange mechanism, that is the conversion of deposits into digital euro, in times of financial stress, similar to closing bank branches in traditional bank runs? Okay, so I think this is really a lot of comments. Katrin and colleagues, what's your take on these?
Yes. So Katrin, shall I?
You go for the bank runs?
Yeah. So basically, I think these are very key. I think these are very key points. Sorry. No. So as I was saying, I think these are very crucial points. So yes, the answer is yes. And these are my personal views. This might be trickier with a digital euro, because of course one can establish what would be a temporary suspension of convertibility. But then the debate is whether to go for a permanent limit on convertibility or a temporary one. And the thing here is, if you go for a permanent one, or permanent limit, you may be limiting the use of digital euro in normal times. But if you go for a temporary one, as this would be the case, you may be actually increasing the probability of a bank run, since agents may anticipate that such suspension of convertibility is eventually going to be activated when the probability of a bank run is sufficiently high, and you could potentially trigger such bank run in a context in which otherwise it wouldn't have occurred, at least from a theoretical perspective. And this is also related to the fact that ex ante and if no other additional design features and regulations apply, one can more easily convert deposits into CBDC than into cash, given existing regulations. So the answer is yes, but there's relevant aspects to take into account in this regard.
Yes, so let me come back to the discussion. So thank you very much for these very insightful and rich remarks. Regarding Marc, so I would first like to say it has not yet been decided that the ECB would issue CBDC. So we are in a project, in the investigation phase of the project, and this means that we are looking at all potential questions that could arise in the context of issuing a CBDC. And the second issue is, so we were looking at this from a monetary policy and financial stability perspective. So there are a host of technical issues that need to be decided, both from technical feasibility and that have, as well as with the interaction for monetary policy and monetary policy implementation. So the question whether limits are enforceable, of course, this is first and foremost a technical issue. So how do you implement this? And then second, if you have seen how the technical implementation is, then you can start discussing whether this is really watertight and enforceable, or whether there are arbitrage opportunities opening up. So we need to collaborate with our colleagues on the technical side to get a grip on all these questions and to really investigate what this means for monetary policy questions and the safeguards we are looking at. We are also not looking at the counterfactual for now, because any decision on issuing CBDC would likely be taken further out in the future, where some of the trends that Marc has sketched will be further on their way, and therefore CBDC would be issued in a completely different environment. And I think everybody agrees that this might change banks' business models quite a lot, and not only because of the decision to issue CBDC, but mainly also because there are a lot of non-bank players evolving in the financial system. So I think this is, the third thing is we are also looking into the question of monetary sovereignty. So we need to be prepared both for potential prevalence of stable coins, but also for potential issuance of CBDC abroad. So there could be a scenario that Euro area citizens are using something like a stable coin or something like a foreign CBDC, and with a decline in cash, some argue that citizens should have access to some form of central bank money, because that's part of monetary sovereignty. And again, there is a particular Euro area perspective to that, because payment services in the large countries of the Euro area, it's right, the payment system is working excellently and there is no issue. But if you would like to pay intra-Euro area, so in smaller countries of the Euro area, with debit cards and with other means of payments, so electronic means of payments, you probably face different conditions than in large countries. So this is something that from a monetary policy perspective and the Euro area perspective is not particularly attractive, and that could give rise to an argument for also issuing a digital means of payment from the central bank. Katrin, on the segmentation of the user market, this is a very interesting thought. So currently we are only looking at segmentation in terms of means of payment. So what are the substitution elasticities on the different means of payment side? So we have less looked into the question, who are the users that probably would first adopt CBDC and who are the users that are probably not adopting CBDC. It is true that it's less an issue in the Euro area of digital inclusion. So financial inclusion is not that bad in most Euro area countries. So CBDC wouldn't be a means to reach the unbanked, but it would rather be another option to affect to do your payments. And the substitution with private stable coins and other crypto assets, we are working on that. So the literature is burgeoning. The monetary policy implications are less clear because there are a lot of means of payments around by many actors. So we are mostly concerned with the CBDC and what is the role for the central bank in this environment. And once there are more data around and more adoption of stablecoins, we should look into that. But currently, stablecoins are less used for retail payments. And the idea of the digital euro is to provide a means of payments for retail transactions and less for wholesale transactions, where, as far as I know, most stablecoins are currently used as a means of intermediating transactions on the wholesale level. So I think I stopped there, and then some of my co-authors would like to react as well.
Yes, Maria, would you, for instance, want to provide further comments, or any of the other ECB authors?
Yes, something very quick, if I may. Just to stress actually the fact that the counterfactual, in the absence of any introduction of a digital euro, is not one where, like also Marc said, where the banking system remains as it is. So the counterfactual actually is potentially, let's say, the dominance of either large banking conglomerates or private players like big tech firms. And therefore, I would just like to stress, let's say, the importance that the digital euro would have for smaller banks, whereby it would help to level the playing field for banks that normally do not have either the capacity or the know-how to compete with larger players in the sector. So that would be from my side. I don't know if someone else would like to add something. Yeah. And thank you for the very nice comments in any case.
Thank you, Maria. Manuel, Oscar, would you have any further comments?
Yeah, I was wondering if Ramon Adalid, who is here with us and is also a co-author, would like to say anything regarding the discussions or...
No, thank you, Manu. I mean, I'm actually, I mean, very happy, very impressed by the comments. I mean, they are very good food for thought. If at all, I would reinforce the comment that Katrin made about monetary sovereignty, and even extend it to the fact that, you know, it's quite a common argument in monetary theory that the possibility, not so much even the use, but the possibility of using central bank money gives unicity to the currency. So in that respect, to Marc's comment, that is not, you know, this is very difficult to have a means of payment that is only a little bit successful, but not too successful. Well, perhaps for the specific case of central bank money, can be the case. The fact that this is successful already, if the possibility of using it exists. So in that respect, you know, one perhaps could reach a middle point. Of course, in the case of a digital means of payment, even in the case of central bank money, you would need some infrastructure, some, let's say, minimum network effect. But the very effect of the possibility, I think, is something very important, as Katrin already said.
This concludes our webinar on CBDC and bank intermediation. Thank you, Katrin, Maria, Manuel, Oscar, and Ramon, for presenting your paper with us. Thank you, Pablo, Katrin, and Marc, for discussing it and for sharing your insights with us. Thanks to all of you for your interest and your questions. You find the links to the ECB Occasional Paper and to the related SUERF Policy Note number 281 on the SUERF event website, and on the ECB Occasional Paper, of course, on the ECB website. Dragana will put up the slides after the event, and we will put up a replay of the video recording in the next few days. Thank you all. Have a nice evening. Bye-bye, and take care.
Thank you.
Thank you very much.
Thank you.
Thank you.
Thank you very much.
Bye.
Bye-bye.
Bye.